You buy at support, confident the floor will hold. Then it shatters, your stop triggers, and panic selling erupts. Here's what you missed. While retail traders cluster their buy orders at these obvious levels, the composite operator sees your stops sitting just below. They drive price through support deliberately, triggering a cascade of liquidations, then accumulate your shares at discount prices before reversing upward. This isn't bad luck, it's engineered liquidity extraction. The smart money doesn't defend support, they weaponize your belief in it. Once you understand absorption and spring patterns, these false breakdowns become your edge. You've done your homework. The chart shows a horizontal line tested 3 times, buyers stepped in each time, price bounced, and now you're watching it approach again. Every textbook, every YouTube analyst, every trading course says the same thing: buy at support with a tight stop just below. You place your order at 47.50, stop at the 46.80, and feel the confidence of a trader who's following the rules. Then, in a single candle, price pierces 46.50. Your stop triggers. You're out with a loss. Minutes later, price rockets back above the 48. What just happened? But before you blame yourself or the market's irrationality, consider this: what if that breakdown was expected? What if someone was counting on your stop, sitting exactly where you placed it? The composite operator, those with sufficient capital to influence price, doesn't see support the way you do. When you see a strong floor, they see a neon sign flashing, Liquidity. Think about the mathematics. Thousands of retail traders all reading the same patterns, all placing buy orders at 47.50, all placing stops at 46.80. This clustering creates a massive pool of pending orders sitting just below an obvious level. To the professional trader operating in size, this represents available inventory. They need your shares, but they won't pay your price. So they create the conditions that force you to sell. Here's the mechanism: as price approaches support, the composite operator begins selling into the buying pressure. They're not defending 47.50. They're testing it, measuring absorption. If the level attracts sufficient volume, they know stops are layered just beneath. A coordinated push through support, often during low liquidity hours or aided by algorithmic execution, triggers a cascade. Your stop becomes a market sell order. Multiply that by 10,000 traders, and suddenly there's a waterfall of supply hitting the bid. The operator who caused the breakdown is now the buyer, absorbing this panic selling at a 46.20, even 45.80 in modern markets. This process is amplified by algorithmic trading. High-frequency traders identify stop clusters through order flow data. Liquidity providers can see the exact depth of resting orders. You're hidden. Stop isn't hidden at all. It's visible in the market microstructure, telegraphed by predictable retail behavior patterns. The transformation in your trading occurs when you recognize that horizontal price levels don't exist to protect you. They exist to concentrate liquidity for those operating at scale. Support becomes meaningful only when you understand who's buying, how much volume is being absorbed, and whether the larger accumulation or distribution pattern supports continuation or reversal. The Wyckoff trader doesn't ask, will support hold? But rather, has the composite operator finished accumulating, or do they need to shake out more supply? Once you view support as the operator views it, as a mechanism for inventory acquisition rather than price defense, you stop being the victim of false breakdowns and start recognizing them as engineered entry opportunities. The trap becomes your advantage, but only after you understand the game being played beneath the surface. The range has held for 6 weeks. You've watched price oscillate between 52 and 58, respecting boundaries like a caged animal. Then, on Tuesday morning, volume surges and price crashes through 52 support like it never existed. Your screen floods red in 51.20, 50.80, the 50.40. Social media erupts. Breakdown confirmed! Bull trap! Jet out now! You hesitate for 30 seconds, watching your position bleed, then capitulate at 50.30. By Friday, the stock is trading at 61. You just sold the bottom of a spring to the very operators who orchestrated your exit. Before you assume the market is random chaos designed to punish you specifically, ask yourself, why would professional money accumulate shares for weeks inside a range, only to abandon their position at the first sign of weakness? They wouldn't. What you witnessed wasn't a breakdown, it was a test. In Wyckoff's accumulations schematic, the spring represents phase D, where the composite operator conducts a final raid below the trading range to accomplish 3 objectives simultaneously. First, they trigger every stop loss sitting beneath support, creating artificial supply from forced sellers. Second, they shake out weak holders who bought during the range but lack conviction. Third, they measure remaining selling pressure. If supply dries up quickly after the breakdown, accumulation is nearly complete. The spring's signature is unmistakable once you know what to observe. Price violates support decisively, often on a wide spread candle that looks catastrophic. Volume spikes as stops trigger and panic sellers emerge. But here's the critical tell: within hours or days, price reverses back into the range, often on narrowing spread and declining volume. That reversal isn't retail buyers rescuing the stock, it's the operator absorbing every share that the breakdown shook loose. In modern markets, you'll see this pattern in everything from large cap stocks to ETFs to cryptocurrency. The Bitcoin spring of March 2020, breaking below 3,800 during COVID panic before rallying to 60,000, followed this exact blueprint. Algorithmic traders now execute springs with surgical precision. They can identify stop clusters through order book data, execute the breakdown during illiquid Asian hours for maximum impact, then reverse during New York open when momentum buyers return. The speed has increased, but the psychology remains identical to Wyckoff's era. Create the appearance of distribution to facilitate accumulation. Your protection lies in preparation. When price has been range-bound and suddenly breaks support on a wide candle with explosive volume, don't react, analyze. Is this selling climactic, or does it show controlled absorption? Does price immediately reclaim support, suggesting the operator is defending their accumulation zone? Are you in a larger accumulation structure where a spring would be textbook? The revelation that transforms your trading is this: false breakdowns aren't market failures, they're scheduled events within the accumulation process. The composite operator telegraphs their intentions through prior price action. Once you recognize the setup, the spring stops being a devastating loss and becomes your highest probability entry signal. You're no longer the victim being shaken out, you're the informed participant buying what the scared money is selling. Support breaks at 63 and your position drops 4% in under 2 hours. Volume bars tower on your screen, 3 times the daily average. The breakdown candle stretches wide, red menacing. Every indicator screams distribution. Your finger hovers over the sell button. The narrative writes itself: institutional money is exiting. Smart money knows something you don't. The uptrend is over. You've seen this pattern destroy portfolios. The volume confirms it, or does it? But what if high volume on a breakdown doesn't always mean what you think it means? What if the same volume signature can represent 2 completely opposite scenarios, and your ability to distinguish them determines whether you profit or panic? The composite operator cannot accumulate large positions without leaving footprints, and volume is their indelible signature. When support breaks on genuine distribution, volume surges and sustains. Price continues falling on successive bars with persistent heavy volume as institutional holders unload inventory. The spread remains wide, the selling relentless. Each rally attempt meets renewed selling pressure. This is real supply overwhelming demand. The composite operator is exiting, and you should too. Contrast this with the spring support breaks with an explosive volume spike, sometimes 5 or 10 times average. But here's the critical difference: the spread rapidly narrows and price reverses. That initial volume burst represents your stops triggering, not institutional distribution. Within 1 to 3 bars, volume diminishes dramatically as price climbs back toward or above the broken support level. The operator isn't selling into that volume, they're buying it. Every share shaken loose by the breakdown is being absorbed by patient capital positioned below the range. In modern markets, you can observe this in real time through level 2 data and time and sales. During a true spring, the breakdown triggers a cascade of small retail sell orders, but large block trades appear on the buy side at the lows. Market makers flip from offering shares to bidding aggressively. The tape shows absorption, big lots traded near the low of the move, followed by rapid price recovery on declining volume. In cryptocurrencies, you'll see this on the order book. Massive bids materialize below support during the flush, then vanish once filled. The modern Wyckoff trader combines classical volume analysis with order flow tools. Use volume profile to see where the operator actually transacted during the breakdown. Analyze cumulative volume delta. If selling volume spikes but buying delta increases at the lows, absorption is occurring. Watch footprint charts showing aggressor orders. Springs show frantic retail selling absorbed by passive institutional bids. The breakthrough in your analysis occurs when you stop treating volume as a simple high or low metric and start reading it as a conversation between supply and demand. High volume alone tells you nothing. It's the relationship between volume, spread, and subsequent price action that reveals intent. A genuine breakdown deteriorates over multiple bars with sustained heavy volume. A spring flashes bright, then immediately reverses on declining participation. Once you decode volume's language, panic becomes clarity. That terrifying breakdown with explosive volume transforms from a signal to exit into your highest conviction buy signal, because you understand the operator just paid for your education by purchasing your shares at a discount. You calculate the perfect stop. Support sits at 44.75, tested twice with precision bounces. You enter long at 45.20, and following every risk management principle you've learned, you place your stop at 44.40, safely below support with a 1% risk. It's textbook position sizing, professional, disciplined. Then Thursday's pre-market session opens, price gaps to the 44.25. Your stop executes at the 44.18, and by noon the stock is back at a 46.30. You followed the rules perfectly, yet you just donated money to someone who knew exactly where you'd place that stop. Before you conclude that stops are useless or that the market is rigged against small traders, consider a more precise truth. Your stop loss wasn't wrong. It was predictable. The composite operator doesn't need insider information to know where your stop sits. They need only understand human psychology and technical analysis convention. When support forms at 44.75, every retail trader using the same chart patterns, the same risk management formulas, and the same trading education arrives at nearly identical conclusions. 40.44, 44.35, 44.25. This predictability transforms your individual stop loss into a collective liquidity pool, visible to professional traders as clearly as if you'd posted it on a billboard. In modern electronic markets, this exploitation operates with algorithmic precision. Market makers access order book depth, seeing the exact concentration of resting stop orders. High-frequency trading firms analyze historical stop placement patterns. They know retail traders place stops 1-3% below obvious support levels. When opportunity aligns low liquidity periods, options expiration pressure, or concurrent with economic data releases, they execute coordinated price moves designed to trigger maximum stop clusters with minimum capital expenditure. A 300,000 sell order during Asian hours can pierce support by 40 cents, trigger 5 million in cascading stop-loss orders, and provide the operator with deeply discounted inventory as they absorb your forced selling. Cryptocurrency markets showcase this dynamic with brutal clarity. Bitcoin support at 30 zaloons an hour attracts stop clusters at a 29,700, 29,500. Watch the order book during a stop hunt. Price wicks to 29,450, liquidating leveraged positions and stops. Volume explodes for 60 seconds, then price recovers to 30,400 within minutes. Blockchain analysis later reveals large wallets accumulated precisely at the wick low. This isn't coincidence, it's harvesting. The evolution in your trading emerges when you recognize that conventional stop placement makes you part of the crowd being exploited. Instead, position stops based on market structure invalidation, not arbitrary percentages below support. Ask, at what price does my accumulation thesis break? Where would the composite operator's position be proven wrong? Often that's significantly further than the tight stop dogma suggests. Use time-based stops during low liquidity windows when stop hunts are most probable. Consider alternative risk management, smaller position size with wider structural stops, or option strategies that define risk without visible stop orders sitting in the book. The transformation occurs when you stop viewing stop loss placement as a mechanical risk calculation and recognize it as a strategic decision that either camouflages you within the hunted crowd or positions you alongside the hunters. Your protection doesn't come from placing stops where they should go. It comes from placing them where the operator doesn't expect them or eliminating visible stops entirely from their targeting algorithms. Support appears at 78th, identical to the level that held 3 months ago. You buy confidently. After all, the chart shows clear evidence that buyers defend this price. Your entry triggers at 78.20 with a target of the 85. Within 2 days, price collapses through 78, then 75, then 70 and doesn't stop until 64. You're stopped out with a devastating loss, bewildered because support was supposed to hold. Meanwhile, another trader looked at the same 78 level during that earlier test and bought aggressively, rode it to 92 and exited weeks before your entry. Same price level, opposite outcomes. What did they see that you missed? Perhaps the answer isn't in the horizontal line at all. Perhaps you were asking the wrong question entirely. Support and resistance levels are meaningless without understanding where they occur within the larger market structure. The composite operator's campaign unfolds across distinct phases, each with different objectives, different price behavior, and different probabilities for support holding or failing. When you bought at 78 3 months ago, during Phase B of accumulation, you were aligned with the operator building a position. The preliminary support and secondary tests were absorbing supply. Support held because the composite operator needed it to hold. They weren't finished accumulating. But when you bought at 78 last week, you were entering during Phase D of distribution. That identical price level now represented an upthrust after distribution, a final rally designed to attract late buyers before the markdown begins. The operator was no longer defending 78. They were using it as an exit point to distribute shares to you and traders like you. The level looks the same on your chart, but the cause behind it has reversed completely. In modern markets, recognizing these phases requires synthesizing multiple data streams. During accumulation's selling climax, you'll see capitulation volume, wide spreads downward, then an automatic rally as short covering an operator buying creates the initial bounce. The secondary test returns to the SC area on diminished volume, proof that supply is exhausted. These aren't random bounces, they're structural phases building the cause for the subsequent markup. Contrast this with distribution. The preliminary supply shows the first failure to make new highs with conviction. The buying climax represents euphoric retail participation at the top. The upthrust tests overhead supply, confirming the operator is selling into strength. When support appears during distribution's Phase D, it's not support, it's a bull trap. Modern tools enhance Wyckoff analysis. Volume profile shows point of control shifting from accumulation zone to distribution zone. On-chain metrics in crypto reveal whale wallets transitioning from accumulation to distribution. Options flow shows institutional positioning shifting from bullish to bearish structures. The revelation that transforms your entire approach is this: horizontal lines don't cause price behavior, they're effects of the underlying accumulation or distribution campaign. When you identify which phase the market is in, through volume characteristics, spread behavior, test patterns, and institutional positioning, you know whether support will hold or catastrophically fail. You stop trading levels and start trading the campaign. That shift in perspective means you're no longer the confused trader buying doomed support, but the informed participant who recognizes the composite operator's intentions and positions accordingly. You've lost money at support more times than you can count. The pattern repeats with haunting consistency. You buy the bounce, place the textbook stop, watch support shatter, get stopped out, then witness price reverse without you. Each lost chips away at your confidence until you question whether technical analysis works at all, whether the markets are truly random, whether success is even possible for someone without institutional resources or insider information. The screen becomes an enemy, and every support level becomes a source of anxiety rather than opportunity. But what if none of those losses were accidents? What if every stop hunt, every false breakdown, every spring that shook you out was following a blueprint written over a century ago? The composite operator's method hasn't changed since the 1900s, only the execution speed has accelerated. They still need to accumulate inventory before markup. They still must distribute shares before markdown. They still require liquidity to enter and exit large positions without moving price against themselves. And they still obtain that liquidity from the predictable behavior of the uninformed majority, clustering at obvious levels with obvious stops. Support doesn't fail randomly, it fails systematically when it serves the operator's campaign to trigger your stops and absorb your shares. Your transformation begins the moment you stop viewing support as protection and recognize it as the battleground where the operator wages war against predictable retail positioning. When you analyze volume to distinguish absorption from distribution, when you place stops based on structural invalidation rather than textbook percentages, when you identify whether you're in accumulation or distribution before you ever consider a horizontal price level. When you understand that the spring isn't market dysfunction, it's phase D of a methodical campaign. The markets aren't rigged against you. They're organized according to principles of supply, demand, and human psychology that remain constant across all time frames and all instruments. The composite operator isn't your enemy. They're your teacher, broadcasting their intentions through price and volume for anyone disciplined enough to study the language. You have a choice. You can continue placing stops where every retail trader places them, buying support because it should hold, and wondering why the same painful pattern repeats. Or you can learn to read the campaign behind the price, recognize when support is an accumulation zone worth defending versus a distribution trap designed to fail, and position yourself alongside the composite operator rather than opposite them. The trap only works on those who don't understand it's there. Once you see the mechanism, you're no longer the victim being shaken out at the bottom of the spring. You're the informed participant buying what the frightened crowd is selling, profiting from the very manipulation that once destroyed your account. That is the Wyckoff edge, not prediction, not hope, but understanding the eternal battle between the composite operator and the uninformed majority, and choosing which side of that battle you'll stand on. The support level hasn't changed, but you have, and that changes everything.